Hello, my name's Charles Delastic. I'm the Managing Director of the Blue Bond Group, and today's video is around how you deal with property companies when there are mortgages inside that company and you still want to put it into a family investment company to eventually avoid the inheritance tax issues around your property portfolio. So how do you deal with mortgages in a family investment company? So dealing with mortgages in an FIC is not really a significant issue because an FIC is effectively a normal limited company, but with the Articles of Association and a strong shareholders agreement in place. So there are a lot of mortgage companies that are more than comfortable with mortgages in companies for landlords. In fact, that is getting to be the norm rather than the exception. Now, there is a 3-year waiting period between setting up the limited liability partnership and then transferring your properties into a family investment company if you currently own your properties personally, that is. Now, you will need to use that 3-year period to rearrange your mortgages, as you will no longer own the properties, the company will own the properties, and so the mortgages have to be changed. Now, if you have fixed rate long-term mortgages already, the properties may need to be placed into a separate limited liability partnership until the term of that mortgage ends. And then if you're claiming incorporation relief, you have to claim incorporation relief on the full limited liability partnership and all the assets it contains into a company. So if you proceed then to set up an employee benefit trust in which to place the capital shares of your new family investment company, the mortgage situation then gets much more complicated. It's tough, if not impossible, to find mortgage lenders to deal with employee benefit trusts because they simply don't understand how this type of trust works, and frankly, they don't want to even take the time to understand it. As a result, this employee benefit trust planning cannot be done while there are outstanding mortgages in the company. So, end result, it means although you've got your properties into a company, you may as well not bother to setting up the family investment company, because if you can't put the shares into an EBT, basically you can't get rid of the shares outside of your estate. And even if you wanted to put the shares of the company into a normal discretionary trust, you'd have a problem with most mortgage companies. Therefore, the issue arises around the mortgages, and you have to remove those mortgages in order to save the inheritance tax. So how do we deal with this issue? To deal with this issue, we would first pass the properties into the family investment company and then restructure the company into 2 separate companies. Now, before you do the restructure, you increase the debt on some of your properties, say to 75% loan to value, and then remove the mortgages on all the other properties. So then the properties with no mortgages stay in the family investment company, while the mortgage properties are then restructured into a completely separate company. Now, although this costs time and money and fees, there are no tax implications once it's all in one company, because the owners of both companies will be the same and you're just literally splitting a company down. Okay, so now as you pay the mortgages off, you could take the properties in the non-FIC company and then pass them into your family investment company. Of course, because you're not claiming incorporation relief at that point, you will then have to pay the stamp duty land tax to move them. Now, if you find our videos useful, why not help a friend and recommend that they watch our channel, because hopefully they'll get the same benefits. So we fully recognize that this is a complex scenario, but at the end of the day, you've got mortgages on your properties. We would normally recommend that most people try and clear the mortgages on their properties by the time they're, say, age 75 anyway, because do you want to take the risk on mortgage interest rates going up dramatically while you're in retirement and you're expecting the income stream from your property portfolio to be more stable? It may just be better to clear a few properties away, pay off the mortgages, have a very steady stream of income with no worries about property mortgages increasing, and then it's stable for you in retirement, and then it also enables us to get all of those properties outside of your estate for inheritance tax. But I totally appreciate that some landlords will want to keep the mortgages, but as I say, it's a problem for the EBT. So going on, if the properties in the non-family investment companies are then mortgaged for 75% of the value, of course only 25% is still in your estate for inheritance tax, because on death it's the value of the properties minus the debt that's still in your estate for IHT, and then you'll be charged the 40% inheritance tax on that difference. But with only 25% still in your estate, you could potentially take out a life insurance policy to cover that liability if that's what you want to do. Right, so the properties in the family investment company will have no IHT liability if you transfer the properties into the employee benefit trust, and it's the capital shares that are transferred in, not the properties. So here's the point: growing properties and growing money in a property portfolio is one thing. However, keeping the money for your children and passing it on tax effectively is a different thing. And therefore, you make money in one way and now you have to keep the wealth in the family. So maybe it will require a slightly different attitude to how you manage your portfolio. So in addition to this, obviously, because of restructures of companies, setting up FICs, setting up EBT, you need to understand that if you want to avoid the tax, you're going to have to take on some complexity if you want to solve both your capital gains tax issues and your inheritance tax problems. So this kind of advice really does need experienced help and advice. So if you are in this situation where you're a professional landlord and you need help to get the properties outside of your estate, why don't you book a meeting with us and then we'll talk it through with you and see how best we can help. Okay, thanks for listening today. Hopefully you found that useful, and bye for now. Bye.